Yes, people, good morning, good afternoon, good evening to all South India students. How are you? Hope so you are good. I am also good. Good morning to all of you. Yes, sir, good morning. So guys, in the yesterday's lecture, we were discussing about the tax treaty topic. Now in the today's lecture, first we will complete the BEPS, that is base erosion and profit shifting. After that, we'll start with the non-resident remaining part. So guys, let's start with the BEPS, base erosion and profit shifting. Yes, good morning to all of you. Shiva, good morning. Yeah. So guys, today we are going to start with one topic, that is base erosion and profit shifting. Now, what is the meaning of base erosion and profit shifting? Base erosion means there are various companies that companies are eroding the base. Means for an example, suppose activity is happening in India. They are doing activity in India, but they are shifting profit at any other country. They are showing profit in the low tax jurisdiction. That is called your base erosion and profit shifting. So they are disappearing the profit from the India, means base erosion. Base erosion means base is eroding. So for an example, I can take an example. In the transfer pricing, we have studied various concepts. Okay, you know that suppose in India there is a one company name is a HUL, and in the UK there is a one company UUL. UUL and HUL will do such a transaction. In that transaction, what happened? They will manipulate the price, and due to that, they will erode the base in India. Means whatever activity happen in India, whatever actual profit earn in India, they will erode the profit and they will shift the profit to any low tax jurisdiction area, or I can say the tax haven country. That is called your base erosion and profit shifting. So what do you mean by base erosion and profit shifting, and what are the adverse effect of the BEPS? This is one expected question in the examination. So first is, what do you mean by the BEPS, base erosion, profit shifting, and what are the adverse effect of the BEPS? This is one expected question in the examination. So all people pay attention. So base erosion and profit shifting and its adverse effect. Guys, it referred to the tax planning strategy. You are planning a tax that exploits gaps and mismatch in the tax rules to make profit disappear for the tax purpose, or to shift profit to the location where there is a little or no real activity but the taxes are low, resulting in the little or no overall corporate tax being paid. That is called your base erosion and profit shifting. So what you are doing? You are planning the tax strategy, you are planning the tax, and what you are doing? You are exploiting the gaps or mismatch in the tax rules. Suppose in India there are separate tax rules, in the foreign there are separate tax rules, because all income tax law is a separate. So you are just using the laws of the every country, and you are disappearing the profit from the country where actual activity is carried out, and you are shifting that profit to the place where there is no real activity but only taxes are low, or in simple word, tax haven countries. Now question is that, due to the BEPS, what will be the adverse effect? Adverse effect means what are the negative effect of the BEPS? So guys, negative effect of the BEPS is very simple. First negative effect is government have to cope up with the less revenue and the higher cost to ensure compliance. So due to the BEPS, what will happen? Suppose we can take an example of the Indian government will get only less revenue, means they will not get sufficient revenue, and there will be a higher cost to ensure the compliance. Higher cost to ensure the compliance means here there will be a less revenue and higher cost to ensure the compliance. That is the first adverse effect. Now, second adverse effect is in developing countries. In the developing countries like India and all, that is called developing country. Still, it is not developed country. So in developing country, the lack of tax revenue lead to the significant underfunding of the public investment that could help foster economic growth. So guys, when government is not getting that much revenue, so what will happen in the developing countries? Government will not able to finance the public investment. Means government will not able to give the money to the infrastructure or hospital and schools and all. So there will be a, not a faster growth, means there will not be a growth in that particular country. So that is the adverse effect of the BEPS. So first adverse effect is very simple. Their government have to cope up with the less revenue and higher cost to ensure the compliance. Second adverse effect is in the developing countries, the lack of the tax revenue lead to the significant underfunding of the public investment that could help foster economic growth. Now third says that BEPS undermine the integrity of the tax system, as reporting of the low corporate taxes is considered to be unfair. Now, when tax law permit businesses to reduce their tax burden by shifting their income away from the jurisdiction where income producing activity are conducted, other taxpayer, especially the individual taxpayer, in that jurisdiction bear a greater share of the burden, and this gives the rise to the fairness issues on account of the individual having to bear the higher tax burden. So guys, what happened, many corporate, or you can say that the multinational companies and all, they are working in the various countries. So what will happen, they will plan their tax structure, they will not pay the more tax, they will pay the only minimum tax or not pay tax. But guys, the individual taxpayer don't have any that type of the strategy, so he can plan BEPS and all. So guys, this is unfair with the individual taxpayer. Now, individual taxpayer is going to pay the higher tax and company corporate are going to pay the lower tax. So that is also an adverse effect, or you can say that negative effect. Now next is enterprises that operate only in the domestic market, including the family owned businesses or new innovative businesses, may have a difficulty competing with the MNEs that have the ability to shift their profit across border to avoid or reduce the taxes. Means fair competition is harmed by the distortion induced by the BEPS. So guys, what happened, there are one company is a multinational company and one company is suppose working only in India. Example is a multinational company name is a Hindustan Unilever Limited. They are multinational companies. Now in the India, suppose one company is running by the Baba Ramdev, name is a Patanjali. So Patanjali is only Indian market. But suppose that HUL is working whole over the world. So what HUL will do? HUL will tax plan by way of they will shift the profit and all, and they will pay very nominal tax or no tax and all. But Patanjali have to pay the tax. So guys, there will not be a fair competition between Patanjali and HUL. So that is an adverse effect of the BEPS. So guys, if any question asked in the examination, what are the adverse effect of the BEPS, you have to write this 4 point. You have to write this 4 point. First point is government will get the less revenue and there will be higher cost to ensure the compliance. Second adverse effect is in developing country, for public welfare, there will be less money. Third, adverse effect, you will write that there are certain companies, they are working in the multinational companies and all, but there is an individual taxpayer. So on individual taxpayer, there will be a higher tax burden. So there is no equality in simple word. And guys, last is suppose one player is working only in the domestic market and one company is working in the international market, multinational companies. So what will happen? Multinational companies will plan the tax. They will shift their profit to the country where tax rate is very low or tax haven countries. But the domestic player has to pay the tax in that particular country. So in simple word, I can say that due to this, what will happen? Okay, guys, there will be not a fair competition between that company as well as the individual taxpayer, that company as well as the domestic company. Now next part is related to the need of international collaboration between the countries. So this was one key question. This time, November 2023 examination, they asked the one question from the BEPS, and in that question, one part was related to this point. Need of international collaboration between the countries. So guys, you know that due to the BEPS, what happened? Everyone, developing countries are losing the taxes, as well as developed country also, they are not getting the taxes. So guys, there is a need to collaborate. All the countries should sit together. They should make some instrument. They should plan some way so they can, that they can counter the BEPS. They can counter the BEPS, base erosion and profit shifting, and they can counter the BEPS. In simple word, suppose if there is a virus, then they should come with the antivirus. So they should made with the antivirus because people are doing the BEPS and also they should come with the antivirus, or you can say that the some combat that BEPS. So they will come with the action plan. So guys, our as of now, there are total 15 action plan, 15. There are 15 action plan, and this action plan is made by the OECD group and G20 group. India is not a part of the OECD, but India is the part of the G20 group. So G20 group and OECD group, they have made one action plan, and there are total 15 action plan. We'll read one by one action plan. So that action plan says that how to avoid this BEPS, how to you can fight with the BEPS, how to restrict the BEPS. So that there are certain action plan, we'll discuss that. But what are the need of international collaboration? Because every country is losing the revenue. So here, interaction of the domestic laws with the other country's law may either lead to the gaps, means no taxation either country, or tax at a nominal rate, or double taxation. Guys, what happened? There is a difference between the domestic laws now. Because suppose Indian Income Tax Act is a different, UK tax law is a different, USA tax law is a different, Thailand tax law is a different, Dubai there is a no tax or tax law is a different, or where there is very nominal tax. So guys, every country is having their domestic tax law is different tax law. Now, since there is a no principle of matching, means payment deductible by the payer is generally taxable in hands of the recipient unless specifically exempted. So if there is a no matching at an international level, it leaves considerable scope for arbitrage by the taxpayer. Guys, suppose for an example in India that some expenditure is allowed, then it should be included in the income of that person. But suppose in India, if any expenditure is allowed, then it should be included in the income of the recipient. But guys, suppose it is not included in the hands of the recipient, it means there is a gap na. It means there is a gap. And to use that gap, people are doing the arbitrage. For an example, in the equalization levy, if you remember, earlier what happened, Google and Facebook and all, they are not having the PE in India. So what happened, whenever from Indian person pay the advertisement expenditure to the Google or Facebook, he claimed the advertisement expenditure as deduction in India. And in their income, it is not included. In their income, it is not included. In their income, it is not included. Okay, so pay attention here. Next part, what this point says that, again, I am reading this point. So here, since there is a gap, or you can say that there is no principle of matching at the international level, it leaves considerable scope of arbitrage by the taxpayer. And BEPS relate to instance where the interaction of the tax rule of different country lead for double non-taxation or arrangement that achieve low or no taxation by shifting profit away from the jurisdiction where the activity creating those profit takes place. International standards have tried to reduce this friction, however, gap is still remain. And therefore, there is a need to countries to collaborate on the tax matter so that they are able to get their due share of the taxes. So this is called need for international collaboration between the countries, because guys, there is a gap, and due to gap, what happened, people are doing the arbitrage. Because in every country tax law is different. In every country, normally, suppose if one in country you are taking the deduction, then in other country it should be taxable. But guys, it is not taxable in various countries and all. So just to reduce that gap, they are saying that there is a need of international collaboration and countries should come with the counter to BEPS. So basically, they should come with some action plan. So here, the action plans were structured around the three fundamental pillars. So basically here, G20 country and OECD country, they have came with the action plan. And guys, there are total 15 action plans, 1 to 15 action plan. We'll discuss one by one. And guys, here, this all action plan are based on some three fundamental pillars. So this was also one question in the examination this time in the November 2023. One small part from here, what are the three pillars based on which the BEPS action plan was made. So guys, BEPS action plan were structured around this three fundamental pillar. First is introducing the coherence in the domestic rule that affect cross-border activity. Guys, they are saying that introducing the coherence means something logical things. Something logical, or we always say that should be there, at least that should be there. So that is called coherence. So in the domestic law, they are saying that introduce the coherence in the domestic rules that affect the cross-border activity. Second says that reinforcing the substance requirement in the existing international standard and alignment of the taxation with the location where value creation and economic activity is performed. So in simple words, second point says that reinforcing the substance means here substance is like substance over form. Don't check the form. Whatever the substance, just check the substance and alignment of the taxation with the location of value creation and economic activity. Means taxes will be charged by that country only where actual value creation or economic activity was performed. Where actual value creation and economic activity was performed, that country should get the taxes. So this is called your substance. And last part is improving transparency and the tax certainty. In all the countries should start improving transparency. Transparency we have discussed about one, that was country by country reporting. So in country by country reporting, like India will share the country by country reporting with the various country will share with the India. So there is a transparency. They will get the all consolidated financial statement of that particular multinational company. So India will get to know that, oh, this company is doing what activity in which country, how much profit they are showing in the other country. So that is called your transparency in the tax certainty. So guys, there are total 15 action plan, and this 15 action plan are based on the 3 pillar. First is a coherence, second is a substance, and third is a improving transparency and the tax certainty. That are 3 pillar. On this 3 pillar basis, now that BEPS action plan or based. Now first action plan, we are discussing one by one action plan. Action plan number 1 is addressing the challenges of the digital economy. Guys, digital economy. So what happened nowadays, you know that digital economy, everyone is doing the online businesses. So there are various challenges in the digital economy. What are the challenges? First challenge is, all people pay attention. Now new business model have created the new tax challenges. The typical taxation issue relating to e-commerce are, first is, there is a difficulty in characterizing the nature of payment. Guys, whenever there is an online business and all, then there is a difficulty in the characterizing the nature of payment and establishing the nexus or link between a taxable transaction activity or taxing jurisdiction. So guys, there is a difficulty in the characterizing the nature of payment. Means any payment is made, that is revenue expenditure or capital expenditure. Whatever amount you have received, this is the revenue receipt or capital receipt. In the online businesses, it is a difficulty in the characterizing the nature of payment, as well as it is difficulty in establishing a nexus or link between a taxable transaction activity and taxing jurisdiction. There is always difficulty in the establishing the nexus or link between, okay, this is the taxable transaction, this is not taxable transaction, or this is activity is a taxable activity, this activity is not a taxable activity, or who will charge the taxing jurisdiction, means which country will charge the tax. So there is always a difficulty in characterizing this payments. Okay, so next part, as well as the difficulty of locating the transaction activity and identify the taxpayer for the income tax purpose. Guys, many times what happen in the digital market, people are making payment by the cryptocurrency. Many times government were not able to locate also, locate the transaction, where that transaction has taken place, where activity has performed, and identifying the taxpayer for the income tax purpose, who will pay the taxes in India. So this is the difficulties. So first point says that there is a difficulty in characterizing the nature of payment and establishing the nexus between the taxable transaction activity and taxing jurisdiction. Second difficulty is a difficulty of locating the transaction, where transaction took place, under which country this transaction took place, or activity, or identify the taxpayer for the income tax purpose. Now guys, the digital business does challenge the physical presence based permanent establishment rules. Because guys, earlier what happened, like before 20 years, there was a PE concept, or still there is a PE concept, but in the permanent establishment, what happened? Like if there is any branch, that is called permanent establishment. If there is any office, that is called permanent establishment. But guys, in the digital economy, there is no concept of PE, because what happened? Like you are having only a website, you are having the server, then it will be treated as PE or not. So what they are saying, the digital business that challenge the physical presence based permanent establishment rule. A PE principle are to remain effective in the new economy. The fundamental PE component developed for the old economy, like place of business, location, permanency, must be reconciled with the new digital reality. Now guys, what are the OECD recommendation? What are the OECD recommendation? So guys, we are discussing about the OECD recommendation. So guys, always for the examination purpose from this topic, 2 type of question they may ask. One question is, what was the OECD recommendation in the action plan? And second question is, what we have incorporated in our domestic tax law. What we have incorporated in our domestic tax law from the BEPS action plan. So there are 2 type of the expected question in your exam. One is the what are the OECD recommendation, and second is the what we have incorporated in our tax law. So guys, here what are the OECD recommendation in action plan number 1? So OECD recommendation means basically BEPS action plan recommendation. G20 country and OECD country, they both came together and started the BEPS action plan. So here, first they are saying that, do one thing, just modifying the existing PE rule, means just change the PE rule in your law, and to provide whether an enterprise engaged in the fully dematerialized digital activity would constitute a PE if it is a maintains significant digital presence in the another country's economy. So here guys, there is a OECD recommendation, and first OECD recommendation says that in the action plan number 1. So in the action plan number 1, first recommendation says that okay, just modify the PE rules, means whatever your PE rules is there, just change that PE rules. And in the PE rule, just put one PE. Okay, suppose if one enterprise is having any economic like a significant digital presence in the another country, then that will be considered as the PE. So incorporate that part in your tax law. Guys, you know that India has included this in our NR taxation. If you remember business connection. Business connection means any person is habitually securing order for non-resident, or suppose he is habitually concluding contract for non-resident, and all that we have discussed. Now guys, that we have discussed. So in India, you know that we have introduced the significant economic presence, if you remember. And significant economic presence means suppose if any non-resident is doing any activity in India with the resident person and that transaction value is more than 2 crore, then it will be assumed that that person is having the significant economic presence in India, and that will establish the business connection. And one more point was there, suppose if there was any like application, and in India there are user are 3 lakh or more, means at least there were 3 lakh user or more in India, then that application is having the significant economic presence in India, and it will be treated as a business connection. So here first recommendation, and from this recommendation we have changed our law. So here guys, OECD recommendation, what are the OECD recommendation? First recommendation is like modify existing PE rule to provide whether an enterprise engaged in fully dematerialized digital activity would constitute a PE if it is maintain a significant digital presence in the another country's economy. Now second recommendation was a virtual fixed place of business PE when an enterprise maintain a website on a server of other enterprise located in the jurisdiction carrying on the business through that website. So guys, suppose in your country, if any company is maintaining the server, then just treat server as a PE. Means server is in your country, then just treat that server as a PE, permanent establishment, and charge the tax on that enterprise doing the activity in your country. So here guys, this point says that virtual fixed place of business PE when the enterprise maintain a website on the server of another enterprise located in the jurisdiction and carrying on the business through that website. So server is located in any country, then that server place will be treated as your PE, permanent establishment. Now next point is a point number 3. Point number 3 says that imposing of the final withholding tax on the certain payment for the digital goods or service provided by the foreign e-commerce provider. So guys, they are saying that imposition of final withholding tax. Final withholding tax means just impose the TDS. Because suppose if you purchase any goods from the non-resident or purchase any service from the non-resident, then just deduct some TDS. And guys, last point is a imposition of the equalization levy on the consideration of certain digital transactions received by non-resident from resident or non-resident having PE in the another country. So just impose the equalization levy. And in India, impose the equalization levy on the 2 transactions. One is your digital advertisement, and second is if any non-resident is sale of goods through the e-commerce, he is an e-commerce operator, and suppose he is doing the activity of the 2 crore or more, then he has to pay the 2% equalization levy. So India has, like you know that we have implemented, one is this last recommendation, equalization levy, and one is this first recommendation of the significant economic presence. That too we already incorporated in our tax law. So guys, here provision incorporated in the Indian tax law is significant economic presence already covered in the topic number 2, and equalization levy is already covered in the topic number 5. This 2 recommendation we have incorporated in our Indian tax law. So in the examination, there may be an expected question from this particular action plan. Action plan number 1 says that okay, what are the OECD recommendation under the BEPS action plan number 1 and what we have incorporated in the Indian tax law. So in Indian tax law, we have incorporated 2 concepts. One is the equalization levy and one is the significant economic presence. You got my point or not? Yes. Now guys, action plan number 2. And from action plan number 2, we have not incorporated anything. From action plan 2, we have not incorporated anything. This is the action plan number 2. Now action plan number 2 is a neutralize the effect of the hybrid mismatch arrangement. Now here, hybrid mismatch arrangement, or you can say that HMA, hybrid mismatch arrangement. Now what are the hybrid mismatch arrangement? Guys, hybrid mismatch arrangement is basically, this exploits a difference in the tax treatment of an entity or an instrument under the law of the two or more countries to achieve the double non-taxation. What people are doing, guys, you know that due to the hybrid mismatch arrangement, they exploit the difference in the tax treatment of an entity or an instrument under the law of the two or more countries to achieve non-double taxation. This is called hybrid mismatch arrangement. Don't worry, I will give you some example. What is the hybrid mismatch arrangement? So they are saying that example is, first is creation of two deduction for a single borrower. Means suppose single loan is taken, but you are taking deduction at two places. Means loan is taken one and you are claiming interest deduction in the two countries. That is called double non-taxation. You are not paying the tax in both the country, means you are taking the two places deduction. Now how it is taken, I will give you example, don't worry that. Now, or taking the deduction without corresponding income inclusion. Means in one country you are claiming one deduction, but other country it is not included in the income. Third is the misusing the foreign tax credit, and last is a participation exemption regime, means showing activity in the low tax jurisdiction. These are some example of the hybrid mismatch arrangement. Now you may be like thinking that how people are doing that, how that creating of two deduction of the single borrower is possible, or how taking deduction without corresponding income inclusion is possible, or how misuse the foreign tax credit. So we will take the example, and from that example we will understand. Guys, what happened? There are two words, one is the transparent and one is the opaque. What is the meaning of transparent? This glass is transparent or opaque? Just tell me, Meghna, this glass is a transparent or opaque? Opaque or transparent? This glass is transparent or opaque? There are two words, one is the transparent and one is the opaque. So this glass is transparent or opaque? Yes, this glass is basically transparent. This glass is basically transparent. So this glass is transparent, but this is opaque. Opaque means you cannot see from this. This is called your opaque. Now guys, what happened? I can take one example, and from that example I will explain you. For an example, here this is India, and suppose in India there is a one partnership firm is there. Partnership firm is there. And guys, this partnership firm is having the three partner, that is Mr. A, that is Mr. A, Mr. B, and Mr. C. There are three partner in the partnership firm. So partnership firm, there are three partner, Mr. A, Mr. B, and Mr. C. So there are three partner, and guys, all three partner are from the UK. All three partner are from the UK. There is a one partnership firm in India, and there are three partner A, B, and C, and all three partner are from UK. Now guys, there are two concepts. One is the transparent entity and one is the opaque entity. Opaque entity means, like suppose one entity and everyone recognize that as an entity, separate entity, that is called opaque entity. And suppose if there is a transparent, it means this is not an entity. Ultimately, they are known as the entity. In India, you know that firm is treated as a separate entity. In India, firm is a separate entity. But guys, for an example, UK law says that, UK domestic tax law says that no, firm is not an entity. Ultimately, partner are entity. And suppose UK is following the transparent rule. For any entity, for the identification, suppose UK is following the transparent rule and India following the opaque rule. Means India recognize partnership firm as a firm, but suppose UK says that no, partnership firm is not an entity at all. We follow the transparency rule. And we says that this partner are treated as entity, this firm is not treated as entity. But Indian tax law says that no, firm is treated as entity, so we follow the opaque rule, and suppose UK follow the transparent rule. Now what happened, guys, try to understand. For an example, this partnership firm took one loan from the State Bank of India. Suppose they took one loan from the SBI and this partnership firm paid the 10 crore rupees interest. Now guys, Indian tax law says that firm is a separate entity. Firm is a separate entity. We will charge the taxes in hands of the firm. So guys, here firm will prepare the P&L account, and in that P&L account here they will claim the interest deduction of the 10 crore. In the P&L debit side, they will claim the 10 crore as an interest deduction. Means firm will claim the 10 crore as an interest deduction in the P&L debit side. Now guys, that is as per Indian tax law. Now in the UK, what happened? UK says that this firm is not an entity at all. Here we follow the transparent rule. Transparent rule means directly it is a transparent. So here this firm is not an entity at all. Here Mr. ABC are entity. So what will happen? Whatever interest 10 crore here paid by the partnership firm, UK law will say that no, it is interest is allowed in the hands of the ABC. And here guys, A, B and C, they will claim the deduction of the 3.34 crore, 3.34 crore, 3.33 crore. So deduction will be claimed by the Mr. A or Mr. B or Mr. C. So can I say that there is a single borrowal? Borrowal means loan is a single, but deduction is claimed by two entities. Now that is due to the hybrid mismatch arrangement. Why there is a hybrid mismatch arrangement? Because one country says that any entity is a transparent and one country says that any entity is a opaque. So due to this, what is happening basically, like due to this particular concept, what is happening here, this deduction is claimed by the two entity in the two different countries, guys, due to the mismatch arrangement. Because one tax law says that firm is a transparent and one tax law says that no, firm is a opaque. Now there may be possibility that there are two instruments, they are treated like differently. For an example, one country treat any instrument as a equity and one country treat any instrument as a debt. Then there may be a like a mismatch arrangement. How? I can take an example. Suppose for an example, in India there is a India and suppose there is a USA. Now for an example, suppose from India one interest is paid to the USA on one instrument. Now that instrument is suppose debt in India. In India that instrument is called as debt, but in USA that instrument is called as equity. There may be possibility that in India that instrument is called as debt and in USA that instrument is called as equity. So what will happen in India basically, guys, when you will prepare the account in the India, then you will claim the interest here. And guys, in the USA treating that is as equity. So suppose they are not including in the income and they are saying the dividend is exempt. So guys, from India, suppose on any instrument you are paying, in India treat that is as debt and suppose USA treat as a equity. So what will happen? There will be a mismatch arrangement. Here you will claim the deduction, but it will not be included in the income of that country. It will not be included in the income of that country because that country treat as a equity, you treat as a debt. So this is the mismatch arrangement. Now this is called your hybrid mismatch arrangement. This is called your hybrid mismatch arrangement. And guys, due to the hybrid mismatch arrangement, what you are doing, creating the two deduction for the single borrowers. Means here you took the loan from SBI, interest is a 10 crore. 10 crore is claimed as deduction in the India as well as 10 crore claim the deduction in the UK. Now guys, taking deduction without corresponding income inclusion. Here you are not including the income in this USA. You are not including the income in the USA. You are not including the income in the USA, but you are claiming deduction in the India. So here you claim the deduction in India and here you are not including the income in the USA. Now next point says that misuse the foreign tax credit. Suppose foreign tax credit, you paid the taxes in foreign and you are taking that credit in 2-3 countries. Suppose you are taking that credit in the USA also, UK also and India also, you are taking the foreign tax credit. So that is called your misuse of foreign tax credit. As well as the participation in the exemption regime, means you will show the activity in the no tax jurisdictional area. Now what are the recommendation of OECD to remove the hybrid mismatch arrangement? So here recommendation from the OECD says that first is change in the domestic law, change your normal income tax law and make rule to neutralize the effect of the hybrid mismatch arrangement and change the tax treaty to deal with the dual residency concept and transparent entity and hybrid entity. So guys, they have given the two recommendation. One recommendation says that just change your domestic law and make rule to neutralize the effect of the hybrid mismatch arrangement, as well as the change the tax treaty to deal with the dual resident companies, transparent entity and the hybrid entity. So guys, here the recommended general amendment, what amendment is required? So here first is saying that rule denying the transparency to the entity where non-resident investor resident country treat an entity as opaque, that is non-transparent. Suppose one country treat any entity as a opaque and one country treat any entity as a transparent, then that country should not be treat that entity as a transparent. Means one country is treating that entity as a opaque, then other country should also treat that entity as a opaque only. Or one country treat any entity as a transparent, then other country also treat that entity as a transparent only. And there is a one example is given. This example is similar to this. Here I took the example firm and partner. So in the similar line, they have given one example. ICI has given one example. Next part. The rule denying the exemption or credit of foreign underlying tax for the dividend that are deductible by the payer. So guys, here for an example, one country treating any instrument as a debt and one country treating that instrument as a equity, then on the debt interest is allowed, but on the equity suppose dividend is not taxable. So what people are doing, suppose one country treating that as a debt and claiming the interest, then other country is not treating as a debt and they are saying that it will be treated as equity, then it should be included in the income. Means exemption should not be given on the dividend. So this is the second recommendation. Okay, suppose this is the one example. Okay, India treating any instrument as a debt, then USA treating as a equity, they should not treat as a equity. They should also treat as a debt, and whatever income received by the US person, that should be included in the income and they should pay the taxes. So here, and last rule says that rule denying of foreign tax credit for withholding tax where the tax has already been credited to some other entity. Means suppose foreign tax credit is already claimed by some other entity, then that foreign tax credit will not be allowed in the another country. You got my point or not? Yes. So this was general amendment recommended by the section plan. Now guys, we are going to start with the one more concept in the hybrid mismatch arrangement in the rule number 2 only, and that is the branch mismatch. Now what is the branch mismatch? I can take one example, and from that example we will understand. Guys, suppose in USA there is a one company that is Kin Limited. In USA there is a one company name is a Kin Limited. Now guys, this Kin Limited is having branch in India. This Kin Limited is having branch in India. Means one foreign company is having branch in India, and guys, this Indian branch, basically Indian branch prepare the P&L of the branch, and guys, there are some expenditure which are allowed, there are some income that is taxable in India. So branch will prepare the P&L in India, branch will pay the taxes in India. Now guys, suppose here net profit comes to the only 10 crore rupees. 10 crore is the next net profit. So on 10 crore, they have paid the taxes in India as per the Indian tax law, because in branch in India, they have to pay the taxes. Now guys, what happened? This Kim Limited will include this profit in their USA tax law also, and they will claim the double taxation relief and all. Now guys, there may be possibility that Indian tax law required the separate rule for computation of income of branch, and USA tax law required the separate rules for the computing income of the branch. So guys, for an example, Kim Limited has prepared the P&L account of Indian branch, and guys, as per the USA tax law, suppose there is a profit comes to the 25 crore. There may be possibility now that profit comes to the 25 crore. Now how it is possible? Guys, in India you are saying that profit is 10 crore, in USA you are saying that profit is 25 crore, and guys, on this 10 crore they already paid the taxes. So on the Indian branch profit, obviously they will not pay the tax, any tax in the like USA, because in India they already paid the taxes. So guys, now there may be a question in your mind of how this profit is different. In India, you are saying that branch is having profit of 10 crore. In USA, how this branch is having the profit of 25 crore? Guys, this is due to the hybrid mismatch arrangement of the branch computation of income. Guys, you know that when branch pay any amount to the head office, then in India that deduction is allowed only 5% of adjusted total income. You know that in the PGBP topic, there was one section related to 44C, and in 44C we have discussed that. In the 44C we have discussed that. In the 44C we have discussed that if branch paid any amount to the head office, then branch can claim that head office allocated expenditure only up to 5% of adjusted total income. Only up to 5% as a adjusted total income. So only up to 5% at adjusted total income means, guys, only 5% expenditure is allowed. So here, like in India, tax law is different, USA tax law is different. So guys, there, due to the computation rules difference, there will be a separate profit in the USA, there is a separate profit in India, and due to that, what happened, many times people are not paying tax in both the countries due to the branch mismatch arrangement. So this is called your branch mismatch arrangement. So branch mismatch means for the computation of income for the branch, one tax law is different, other tax law is different. So what this says, try to understand. Branch mismatch occur where two jurisdictions, like in this example, India and USA, take a different view as to the existence of or the allocation of income or expenditure between the branch and the head office of the same taxpayer. Branch mismatch arise where the ordinary rules of allocating income and expenditure between the branch and head office result in the portion of the net income of the taxpayer escaping charge to taxation in both the branch and the residence jurisdiction. Unlike hybrid mismatch, which result from the conflict in the legal treatment of entity or instrument, branch mismatch are the result of the difference in the way of branch and head office account for the payment made by or to the branch. So guys, what happens? Both the countries' law is different. Like one country says that on the branch for the allocation expenditure, we will allow the 5%, but other country says that suppose we will include the only 3% and all. So their inclusion of income is very less, and here expenditure is allowed as a higher, and due to that they save the taxes, they not paid the taxes in any country. That is called your branch mismatch arrangement. So guys, under this particular rule, that is neutralize the effect of the hybrid mismatch arrangement, always you have to remember 2 points. One is the hybrid mismatch arrangement. Basically what they are doing, they are exploits the difference of the tax treatment in the entity or instrument. Means one country treating any entity as a transparent, one country treating any entity as a like a opaque. So they are using that way. Or mismatch in the instrument, one country treating any instrument as a equity, one country treating any instrument as a debt. So they are using gap between that. So guys, that is called your hybrid mismatch arrangement. And to avoid that, first they are saying that rule denying the transparency of entity where non-resident investor resident country treat entity as opaque. Means one country treat any entity as opaque, then other country should also treat it opaque. Or one country treat any like instrument as a equity, then other country also treat as equity only. Or one country treating the debt, then other country also treat the debt. As well as the suppose foreign tax credit paid is already claimed by any entity, then other country any other entity cannot claim that foreign tax credit. So that is called your 3 rules. And branch mismatch means suppose branch is located in one country, head office in the other country, and there are tax rules are different. Tax rule are basically different, and to compute the income of the branch, like one country law is different, another country law is different, and due to that what happened, due to that in the both the countries on the some portion or certain portion you not pay the taxes. So guys, they are saying that just remove that effect. Now next part is a action plan number 3. Action plan number 3 is related to the strengthen control foreign company CFC rule. Now what is the CFC? Basically I can take one example, and from that example we will understand what is the CFC rule. Now CFC is action plan number 3. Now CFC is action plan number 3. I can take an example. Hey guys, suppose in India there is one company, BB Virtuals Private Limited. So in India we are having one company, name is a BB Virtuals Private Limited, and this company is a resident company. So whole world income is taxable. Now guys, for an example, we are getting income from Dubai also, because in Dubai we have the students, so we are having income from Dubai also. And for an example guys, suppose this company is having one property in the Dubai. So property in the Dubai. So guys, from that property, this company is getting the rental income. Now we know that when we are the resident in the India, then whole world income is taxable. So what we will do? We will not take the property in the name of this Indian company. What we will do? We will create one CFC. CFC means controlled foreign company. So what happened? This company have created one BB Virtuals Dubai Private Limited. Dubai Private Limited. Now guys, this Dubai Private Limited is located in Dubai. But this company, suppose 90% share are held by this company. 90% share are held by the Indian company, and BB Virtuals Dubai Private Limited is that company. Now rental income is received by this company, and this company is basically non-resident. Now this company is basically non-resident, so in this company's hand nothing is taxable in India. In this company hand, Dubai, like BB Virtuals Dubai Private Limited, nothing is taxable in India because this company is non-resident. Now rental income is received in Dubai, as well as the suppose some pen drive sold in Dubai, some books sold in the Dubai. So this company is getting that income in the Dubai. So nothing is taxable in India. But suppose we have not created this company, then everything is going to be taxable in hands of the BB Virtuals Private Limited. So this company is known as the CFC. CFC means controlled foreign company. So this company is basically controlled by this company, BB Virtuals Private Limited. Now guys, when this company is controlled by this company is controlled by this company, then like income is not taxable in India, and they used to park the earning or income in the Dubai only. They used to park all the earning or income in the Dubai only. That is not taxable in India at all. So guys, when they were doing this type of activity, then here income is not taxable in India. Income will be taxable in India only when this company will give the dividend to the Indian company. But this type of company never give the dividend to Indian company. Then guys, here this rule says that CFC, Controlled Finance Foreign Corporation, this action plan says that just change your law, and in law just write that whatever income is earned by the CFC, Controlled Foreign Company, should be taxable in hands of the parent company. Means that income is earned by this company should be taxable in this company hand. So that is one recommendation, you should make the CFC rule. Whatever income earned by your controlled foreign corporation, it should be taxable in hands of this company. But guys, still India has not created any CFC rule in the law. We have not created any CFC rule, or we have not included any CFC rule in Indian tax law. But guys, if you remember, then in the non-resident taxation, there was a residential status topic. And in the residential status, we have included that POEM concept, place of effective management and control. So guys, if this foreign company is having the POEM in India, POEM is, if you remember, that there was there was an active business outside India, as well as the majority board meeting held outside India. Then POEM is located outside India. Otherwise there may be possibility that POEM will be located in India. So due to the POEM concept, what happened? Guys, due to the POEM concept, here in Indian tax law, we mentioned that suppose if this company's POEM is located in India, then that company will be treated as resident in India, and whole income will be taxable in India. So this we have included in our tax law. So pay attention. Now, what is the CFC? So foreign controlled foreign company means CFC are corporate entities incorporated in the tax haven countries. So they are incorporated in the tax haven countries. Tax haven countries means like Dubai or Singapore or Mauritius and all, and controlled directly and indirectly by the resident of the higher tax jurisdiction, that is called parent state. Like example is BB Limited is an Indian company, set up a subsidiary in Dubai, that is tax haven, BB Dubai Limited. In this case, BB Dubai Limited is treated as CFC. Now, normally CFC earn passive income and accumulated such income in the tax haven countries. Such income is taxable in the parent state only. If CFC distribute dividend, but practically CFC never distribute dividend, so such income is never taxable in hands of the parent entity. Now, to curb these practices, many countries come out with the CFC regulation. Now, as per the CFC rules, income earned by CFC is deemed to be the income of parent entity and taxable in the parent state only. Normally, a CFC rules applicable on the passive income like interest, royalty, dividend, income from transaction with the related parties, etc., etc. So this is the action plan number 3. Now, plan number 4 is very simple. That is interest deduction and other financial payment, or it is known as the thin capitalization. It is known as the thin capitalization. Now, guys, what is the action plan number 4? So here guys, action plan number 4 is basically interest deduction and other financial payment, that is called thin capitalization. What this particular action plan says that, now try to understand. This action plan says that what happened in the countries where tax rate is higher, companies always prefer debt over the equity. You know that in the transfer pricing topic, we did one section 94B. And in 94B, if you remember that EBITDA, earning before interest, tax, depreciation and amortization, there should be a 30% interest allowed in the current year. That EBITDA limited, that we have opted from this action plan. Because guys, what happened in the high tax jurisdiction, always multinational companies take the loan rather than funding through the equity, because there will be a more interest deduction, and when interest deduction is more, so their taxable profit will be less, and they have to pay the very less tax in that country. So here what this point says that normally international group taking loan or debt in the high tax jurisdiction, because interest is a deductible expenses, they can reduce their overall tax liability. Now many times enterprise of the multinational enterprise group located in the tax haven gives loan to the entity located in the high tax jurisdiction, so their overall tax burden get reduced. Now what were the recommendation of the OECD? Guys, recommendation of OECD was, first is a fixed ratio rule. Fixed ratio rule means just give one standard ratio, like your interest expenditure can be this much only. So India opted this, and India says that 30% of EBIT DA can be your interest. So here, interest deduction should be allowed on the basis of level of economic activity. As per this rule, interest is allowed at certain percentage of the EBITDA, like India 30%. Now one is the group ratio rule. Group ratio rule means, suppose for an example, for any multinational group, decide one ratio. Means for an example, there is a Unilever group. So for Unilever group, we can decide the ratio. Okay, Unilever group whole world, their interest expenditure should not be more than 5% of EBITDA. So that is called your group ratio rule. Now India has not followed the group ratio rule here. As per this rule, the entity means Unilever, allowed to deduct more interest expenses on the basis of position of its worldwide group. Now guys, targeted rule. Targeted rule means you should make some rule to target, especially exclude the entity, or there is a no risk, like in the banking and insurance business. You know that in the transfer pricing we have discussed the section 94B, and 94B says that 94B section says that in case of the like banking company and insurance company, that 94B, that 30% EBITDA limit is not applicable. So here this should be the certain rule to address some specific risk in case of the banking and insurance business. If there is no risk, then country can exclude banking and insurance business. So if there is no risk, then you can exclude the banking and insurance business, and we have excluded the banking and insurance business. Now provision incorporated in Indian tax law is a section 94B incorporated in the transfer pricing. So here guys, this is the action plan number 4, or you can say that the interest deduction and other financial payment, or in simple word we can call it the thin capitalization. In the simple word we can call it thin capitalization. Now guys, next part is related to the counter harmful tax practices, that is action plan number 5. And action plan number 5 says that counter harmful tax practices. Now what is the counter harmful tax practices? Counter harmful tax practices. Guys, what people were doing, you know that they developed the intellectual property, means IP, in one country. Substantial activity also did in that country, research they did in that country, but they registered that patent in some tax haven country. They registered the patent in the tax haven country. Now question is, why they are registering the patent in the tax haven country? So for an example, I can take an example. During the during the COVID period, you know that Covishield, one vaccine was invented by the Oxford AstraZeneca. Now Oxford or AstraZeneca, they are basically from UK. But what happened, if this is just an example, suppose they invented the vaccine in the UK, all activity done in the UK, but guys, they registered that vaccine, for an example, in the Cayman Island. They taken the patent in the Cayman Island, and they created one company in the Cayman Island, and they have registered that patent in that country. And they are, because Cayman Island, there is no tax at all. So now that company is registered in the Cayman Island, they registered their patent in the Cayman Island. In Cayman Island, there is no tax at all. So guys, what will happen? You know that now they will get the royalty on that patent. So every country will pay the royalty and all. And on that royalty in Cayman Island, there is no tax at all. So people were doing that type of practices. That is called your harmful tax practices. So here there was an action plan number 5, and action number plan 5 says that, okay guys, to counter the harmful tax practices, you should change in your domestic law. And in domestic law, give the lower rate benefit on the royalty only if the substantial activity carried in your country. Means to the, suppose for an example, Cayman Island is also part of this group, like OECD group, G20 group and all. Then they ask to that country like Cayman Island, okay, you should not give the benefit of that the lower tax rate or low rate tax rate on the royalty when that person has not did any activity in your country. They have just registered the patent in your entity country, and you are giving the lower tax rate benefit or no tax rate benefit on the royalty. So here guys, in India, which section we have incorporated? You know that we have incorporated one section 115 BBF. And 115 BBF we have discussed in the first topic of the first volume, and we have discussed that suppose if there is any royalty on the patent and that patent was developed in India. If that patent was developed in India, then that royalty is taxable at the rate 10%. That royalty is taxable at the rate 10%. That royalty is taxable at the rate 10%. So guys, if any patent is developed in India, then that royalty is taxable at the rate 10%. But you know that in that section, it was clearly mentioned that 75% expenditure should be incurred in India. If 75% expenditure incurred in India, then only that lower tax rate of the 10% benefit is available. Otherwise, that 10% benefit is not available. So just read whatever given here in the action plan number 5. Just read it. Just read it. Yes, people, done with the action plan number 5. Now there is a action plan number 6. And action plan number 6 says that preventing the treaty abuse. Treaty abuse. Preventing the treaty abuse. Treaty abuse means, guys, you know that various people are doing the treaty shopping. Treaty shopping. You know that I have explained you one concept called treaty shopping. Now, what is the treaty shopping? For an example, India and Mauritius is having one treaty. India, and here it is Mauritius. India and Mauritius is having one treaty. India and Mauritius is having one treaty. There is a one treaty, that is India and Mauritius. Now, India and Mauritius is having one treaty, and suppose Mauritius and India treaty says that if any person of the Mauritius, means resident person, if he is getting profit from India on the capital gain, suppose there is no tax in India. No tax in India. Means in India there will not be any tax if any person of the Mauritius is getting capital gain from India on the security. There is a treaty between India and Mauritius. Now guys, suppose for an example, there is a one person from Pakistan. If Pakistan person wants to invest in the Indian share market, if directly he invests, then in India he has to pay the taxes. So what he will do, you know that? First he will visit the Mauritius. So Pakistan person will visit the Mauritius. He will incorporate one company in the Mauritius. So that company will be the resident of Mauritius. Now guys, that company will invest in the India. That company basically will invest in the India. That company will invest in the India. That company will invest in the India. So when that company will invest in the India, and guys, they will say that okay, there should be a benefit of this treaty, and they will not pay any tax in India. This is called your treaty shopping. Treaty shopping means this treaty was basically for the India Mauritius people only. But Pakistani person is taking the benefit of this treaty. That is called your treaty shopping. So here a lawmaker says that okay, there should be avoidance of the treaty shopping. This should not be permissible. This should not be permissible. Means treaty shopping should not be permissible. It should be not permissible. So here, this is the action plan number 6. That is preventing treaty abuse or treaty shopping. So here, protection against the treaty shopping. So here, treaty shopping means taking the benefit of any treaty by any person which is not meant for that person. Suppose as per the India-Mauritius treaty, if a person resident of Mauritius earning capital gain on shares of Indian company shall not be taxable in India now. Now suppose any person resident of UK incorporate a shell company in Mauritius and tax the benefit of India-Mauritius treaty is called as treaty shopping. Now what are the recommendation of the OECD? Guys, recommendation of OECD. Recommendation says that okay, first put the clear statement in the preamble of the treaty that such treaty is for the avoidance of the double taxation and not for creating the opportunity for non-taxation through the treaty shopping. Means here first recommendation of the OECD was that okay, just put the clear statement in the preamble of the DTAA. Means whenever you make the DTAA, then in DTAA in the preamble only just write that okay, this DTAA is for the avoidance of the double taxation, not creating the opportunity for non-double taxation. Non-double taxation, like you can say the non-taxation, not creating the opportunity for the non-taxation through the treaty shopping. So this was the first recommendation. So they are saying that okay, do one thing, first change the, like you know that first change, put the clear statement in the preamble of the treaty and write in the preamble of treaty that this treaty is for the avoidance of the double taxation, not giving the opportunity for the non-taxation. So just change the preamble. That was the first recommendation. Second recommendation says that LOB rule. LOB rule means limitation of benefit rule. You can write here that limitation of benefit rule. And limitation of benefit rule says that okay, rule based on the objective criteria such as legal nature or ownership or general activities, etc., etc. Example is like as per the India-Mauritius treaty, resident of Mauritius shall be liable to pay tax in India on the shares at the rate 50% of Indian tax rate. Guys, here what happened in the India and Mauritius treaty? Now they have mentioned that okay, suppose if from Mauritius, because in Mauritius there is no tax, so if Mauritius person is earning capital gain on the shares from India, then he has to pay the tax at the rate 50% in India. Means suppose under section LTCG 112A their tax rate is 10%, then that person has to pay the only 5% tax in India. That person has to pay the 5% tax in India. So that person will pay the 5% tax in India. But guys, this benefit of 5% will not be available if that person in the Mauritius is not having their operating expenditure of 7 lakh at least in the previous year. So here in the next line what they are saying, but this benefit of the 50% tax rate in India is not available Mauritius resident shell company whose operational expenses is less than 7 lakh rupees. So guys, for an example, if Pakistani person came to Mauritius and they incorporate company, shell company in Mauritius, then their operating expenditure will not be more than 7 lakh in a year. There will be no operating expenses. So guys, this company will not able to get the benefit of this 50% tax rate. Means then in India, there will be a tax rate of 10% only. So this is called your limited of LOB rules. LOB rule limitation on the benefit. So on the benefit, they have given the limitation. Okay, basically, if any Mauritius person is earning capital gain from India, we will charge the tax at the rate 50% only of the whatever tax rate in India. That is suppose 10%, then only 5% we will charge. But guys, if that Mauritius company is not having the operating expenditure up to 7 lakh in the year, then they will not get the benefit of this 5% rate. Means there will be a limitation of benefit. So here, suppose one shell company is there in the Mauritius, so their operating expenses will be nil, so they will not get the benefit of the 5%. But guys, suppose if there is a genuine company, their operating expenses of 7 lakh rupees or more, in that particular case, obviously they will get the benefit of the 50% tax rate in India, that is 5%. Now there is a one more, that is a PPT rules. PPT rules means principal purpose rules. Principal purpose transaction rule. So principal purpose transaction rule, they are saying that general anti-avoidance rules on the basis of principal purpose of the transaction. So they are saying that like always check that was the principal purpose of investment. What was the principal purpose? Means what was the actual purpose of investment? Just go behind that and make the rule. That is called your PPT rules, or you can say that the principal purpose of transaction rules. You got my point or not? Yes. Now next is the action plan number 7. Now guys, action plan number 7 says that prevent the artificial avoidance of the permanent establishment status. Hey guys, they are saying that prevent the artificial avoidance of the PE status. Now earlier in the earlier tax laws, or in the like PE means any branch or any office or any, like you can say that warehouse, that will be treated as the PE. Now they have mentioned that rework the PE definition. Rework the PE definition. So what was the recommendation in the action plan number 7? Action plan number 7 recommendation was reworking the exception of the PE definition, and to define the PE, all activity carried on by enterprise along with the activity by closely related person should be examined. Now what happened guys? Suppose for an example, there is a one company in UK, they are doing some activity in India, and they are doing activity through different person, and different person, and all are related person. They are saying that it is not a PE, so we are not required to pay any tax in India. So here this recommendation says that rework the exception of PE definition, and to define the PE, all activity carried on by enterprise along with the activity by closely related person shall be examined together. Closely related person should be examined together. So they are saying that suppose there are 5 person are doing activity in India on behalf of the non-resident, so all 5 person activities should be combined together and check that this is the PE or not. And second is analyzing the arrangement entered through the contractual agreement, means business through the commissioners, also including the definition of PE except it is performed as independent business activity. Means suppose for an example, for any non-resident in India, there is a one person is an agent. For any non-resident, suppose there is a one person that is the agent, and that agent is performing the task on the behalf of the non-resident. In India, one agent is performing the tasks on the behalf of the non-resident. You have to check the contractual agreement. Is that agent is a pure agent or not? And if that person is a pure agent, then obviously that person should be treated as a PE in India. So here second point says that analyzing the arrangement entered through the contractual agreement, means business through the commissioner. Commissioner means any person working on the commission basis like an agent. Also include in the definition of PE, but except if it is performed as an independent business activity. Suppose that agent is an independent agent, then obviously it will not be treated as a PE. You got my point or not? Yes. Now next part. Action plan number 8 to 10. Guys, this action plan number 8 to 10 is related to the transfer pricing outcomes in line with the value creation, intangible risk and capital of other high risk transaction. This 8 to 10 rules are given together. Now there is no need to read the rule number 8 to 10, but what are the basically 8 to 10 rule? I am just explaining you. You will able to understand. You know that in the transfer pricing topic, we have discussed various method to compute the arm length price. What was the method? First method was cup method, second was resale price method, third was cost plus method, fourth was profit split method, and fifth was transactional net margin method. Transactional net margin method, you know that what was the profit split method? Now profit split method means, you know that we have discussed that there was a one company in the foreign X Limited. X Limited got one order from the M Limited. They are doing in the joint venture with the B Limited and X Limited, Y Limited, Z Limited. They are doing like activity together in the joint venture, and after that they have divided the profit. and that profit was divided on the basis of the profit were divided on the basis of your in the ratio of the relevant contribution in terms of the capital employed, or in terms of the tax, in terms of the risk capacity, or in terms of the how much employment involvement and all. So guys, how to do that? So they have made some action plan number 8, 9, 10, and in 8, 9, 10 they mention that more profit should be given to the entity who is taking the more risk. Or suppose if anyone is taking very less risk, then that person should not get higher profit. So there are some rule, that is rule number 8, 9, 10, and this 8, 9, 10 is suggest that whenever you do the FAR analysis, FAR, that is asset FAR, function, perform, asset, employed, risk, assume and all, then you should allocate the profit to the entity. If that entity is taking the higher risk, that entity is able to get the higher profit. Or suppose if any entity is taking the lower risk, then that entity should get the lower profit. So that are action plan number 8, 9, 10. There is no need to read for the examination point of view. Now next part is a action plan number 11. Action plan number 11, yeah, you can read it. Action plan number 11 is a measuring and monitoring the BEPS. Guys, how any country will get to know that there is BEPS is happening? What are the indicator? What are the indicator, and from which indicator any country will get to know that there are BEPS is happening, means base eroding and profit is shifting to another country? When any country will get to know that? So here guys, there are some indicator of the BEPS. There are 6 indicator of the BEPS activity. Highlight the BEPS behavior using the different source of data, employing different metrics, and examining the different BEPS channels. When combined and presented as a dashboard to indicator, they confirm the existence of the BEPS. And it continued increase in the scale of recent year. So guys, they have given some BEPS indicator. Okay, if this is happening now, it means there is a BEPS. Now what are happening? Point number 1. Point number 1 is the profit rate of multinational enterprise affiliates located in the lower tax countries are higher than their group average worldwide profit ratio. Guys, they are saying that suppose there is one multinational company, that M&E is a Unilever group. Now Unilever group overall profit worldwide is a 10%. But suppose their one entity is located in the Mauritius or Cayman Island, tax 7 countries, their profit is a 40%. So their overall worldwide profit is only 10%, but guys, in the country where tax are lower or tax haven countries, their profit is a 40%. It means there is a BEPS. It means there is a BEPS, means there is a base erosion and profit shifting. Here it is happening, base erosion and profit shifting. Answer is yes, there is a BEPS. So here what the point number 1 says that, for example, the net profit rates reported by M&E affiliates located in the lower tax countries are twice as high as their group worldwide profit rate average. Means suppose that M&E overall worldwide group profit is a 10%, but in the located Mauritius company or Cayman Island, that is the 20%, means more than twice. It means guys, there is a BEPS is happening. So first indicator is suppose any multinational companies, their overall profit in the world is the lower as compared to the entity located in the tax haven countries. Suppose one company is located in the tax haven countries, and in that countries the profit is a higher. You got my point or not? Yes. Now next part. The effective tax rate paid by the large M&E entity are estimated to be the lower than the similar enterprise with only domestic operation. My second point says that suppose M&E is paying overall taxes lower as compared to the domestic player, Miss Patanjali. Suppose Patanjali tax percentage is a 25%, but if you say the Unilever group overall tax percentage, that is only 5%. So this is also indicator of the BEPS. M&E is paying the overall tax liability is very less, only 5%, but Patanjali is operating in the domestic market. Their tax liability is a 25% or 30%. So this is also an indicator of BEPS. So here, this tilts the playing field against the local businesses for non-tax aggressive M&Es. Although some of this may be due to the M&E's great utilization of the available countries for the tax preferences, that maybe some exception are there. But guys, normally if M&E's overall tax rate is a lower as compared to the domestic local player, it means there may be possibility of the BEPS. Now next part. Foreign direct investment, FDI is increasingly concentrated. Means suppose for an example, in any particular area or particular country, if FDI is increasing, foreign direct investment is increasing, it means there will be a BEPS. It means there will be a BEPS. So in FDI in the countries with the net FDI to the GDP ratio of the more than 200% increased from 38 times higher than all other countries in 2005 to 99 times higher in the 2012. So their GDP to FDI ratio is a more than 200%. Means more than their GDP, they are getting the FDI, foreign direct investment. Means in that country there may be possibility of the BEPS. Now next part, the separation of the taxable profit from the location of the value creating activity is particularly clear with respect to intangible asset, and the phenomenon has grown rapidly. Means for example, the ratio of value of royalty received to spending on the research and development in the group of the low tax countries was 6 times higher than the average ratio for all other countries, and has increased threefold between this 2009 to 2012. So what they are doing basically, guys, value creating activity is doing in some other part, but royalty, they registered their patent in some other country. So if they are doing that type of activity, that will also be the indicator of the BEPS. So what are the indicator of BEPS, guys? First indicator was, suppose that multinational enterprises having overall lower profit percentage, but in the tax haven countries their profit percentage is very high. Second is if you compare with the domestic tax player and the MNE group, suppose that MNE group tax rate, overall tax percentage is very lower as compared to the domestic tax player. Now in any country, suppose if FDI is increasing, it means there may be possibility of the BEPS. After that, suppose separation of taxable profit from the location of value creating activity. Means value creating activity, suppose research took place in the UK, but guys, that registered AstraZeneca Covishield is registered in the Cayman Island or Mauritius. So they are doing this type of activity. And guys, second last point says that suppose royalty received by entity located in this low tax countries accounted for the 3% of royalty received, total royalty. So this provide evidence of the existence of BEPS, though not the direct measurement of the scale of the BEPS. So they have mentioned that, suppose for an example, there is one company name is a Unilever. Now Unilever is getting the total royalty of 100 rupees. Now in that 100 rupees, suppose 3 rupees they are getting from the country where tax rate is lower. It means there is an indicator of the BEPS. So suppose one MNE multinational companies, example is, one more example is, suppose Oracle is a multinational company. Now Oracle is getting the royalty, but royalty from the low tax haven countries, they are getting the at least 3% or more. It means there is a BEPS. And last point, debt from both related and third party is more concentrated in MLE affiliates in higher statutory tax rate countries. Guys, suppose in the higher tax rate countries, they are increasing more and more debt. Means they reduce the equity and they increase more and more debt. So that is called your debt from both related and third parties is a more concentrated in the MNE affiliates in the higher statutory tax rate countries. Means high tax rate countries bear the more interest expenditure, so there will be less taxes in that country. So if that is also increasing, this is the indicator of BEPS. The interest to income ratio for affiliates to the larger global MNE is higher tax rate countries is almost 3 times higher than the MNE worldwide third party interest to income ratio. So in simple word, what they are doing, like in the country like India, their tax rate is higher, 30%, 40%. They will put more and more interest expenses in the India. So this is also indicator of BEPS. Now guys, there is a action plan number 12. Action plan number 12 says that disclosure of the aggressive tax planning arrangement. This action plan says that every country should come up with some disclosure requirement should be made by the MNEs and all. Means every country should make some rule, some law, and in that rule or that law, they specifically mention that this company or country should be disclose certain requirement. But guys, what will happen? So suppose for an example, if there is a disclosure requirement and all now, then income tax authority in advance should aware that there may be BEPS, so they can restrict it. So there should be a disclosure requirement, means they should ask to the companies to disclose more and more transaction and all. So there should be a disclosure mechanism in the country. So here what this point says that design principles and significant objective of the mandatory disclosure regime. And what are the mandatory disclosure regime? There should be clarity and comprehensibility. In that disclosure regime, there should be a clarity and comprehensibility. ability to balance additional compliance cost to the taxpayer with the benefit obtained by the tax admin. But you should not put lots of disclosure where compliance cost is very high and government is not getting much benefit. So there should be a balance between additional compliance cost to the taxpayer as well as the benefit obtained by the government. Now next is a flexibility and dynamism to allow the tax administration, means like income tax authority, to adjust the system to respond to the new risk to or carve out the absolute risk. So here guys, they should have that type of flexibility that they can take any decision wherever there is required. There should be a flexibility in the rules and all, and they should take any decision to avoid the BEPS. Accurate identification of the scheme to be disclosed, effective achievement of the objective, and ensure effective use of information collected. Whatever information they have collected, they should use effectively that information. So that is the action plan number 12, not more relevant for the examination. Disclosure of the aggressive tax planning arrangement. Now guys, action plan number 13, and this action plan number 13 we already discussed in the transfer pricing documentation. Action plan number 13 says that under transfer pricing documentation, there should be a 3 level of documentation, and that we have already discussed in the transfer pricing topic. One was your local file. Local file means TP study report. TP study report means whenever you do the transaction with non-resident associate enterprise, then whenever you do the transaction with the non-resident associate enterprise, with the non-resident associate enterprise, then guys, like you should maintain one documentation as per section 92D, that is called documentation. After that, master file means you should give the information about your group to the income tax authority. That was master file. And one is the country by country reporting, means like a parent entity is a person who is going to prepare the consolidated financial statement. They will give the whole world revenue, whole world manpower, whole world like a number of employee and all, whole world profit after tax, profit before tax and all this information to that country. So that country will share with the every country. That is called your country by country reporting. So country by country reporting. So these are the 3 level of documentation. One is the local file. Local file means TP study report. One is the master file, that is the overview of the multinational companies, and one is the country by country reporting. So these are the 3, you can say that, the requirement of the documentation. Now guys, action plan number 14, and after 14 we are going to take the break. Action plan number 14. Action plan number 14 says that making the dispute resolution more effective, because guys, due to the BEPS action plan, what will happen? There will be lots of disputes due to this action plan. There are various action plan in the like BEPS. So due to the BEPS action plan, there may be a dispute between the parties, dispute between the assessee and the income tax authority. There may be possibility that there is a double taxation due to the BEPS action plan. Then guys, there should be a effective resolution for the disputes. They should come with the MAP. MAP means mutual agreement procedure. And whenever there is a dispute between tax authority and the assessee, then competent authority of one country sit together with the competent authority of another country, and they should resolve that dispute. That is called MAP. So all people pay attention. Due to the implementation of the BEPS action plan, there may be risk of uncertainty or unintended double taxation. The above issue should be resolved through the proper implementation of the tax treaty and resolution of the dispute through MAP. Now, minimum standard, ensure effective implementation of the MAP. MAP means mutual agreement procedure. That treaty obligation related to MAP are fully implemented in the good faith. The MAP cases are resolved on the timely manner. The implementation of the administrative process that promote the prevention and timely resolution of treaty related disputes, and that taxpayer can access the MAP whenever eligible. So guys, they are saying that like dispute resolution should be very clear and very timely basis. You should resolve the dispute. That is the action plan number 14. And after that, action plan number 15 is a developing a multilateral instrument that we will discuss after break. But guys, in the break you have to do some question and you have to check some question. And that question is from your topic number 20. All people pay attention. Topic number 20. Question number 1. Question number 1. What do you understand by the base erosion and profit shifting, and describe briefly the adverse effect? That we already discussed. That was the first part of our chapter. BEPS means base eroding and shifting profit to the low tax jurisdiction country or tax haven countries. That is called BEPS. What are the adverse effect? Basically government is getting less revenue, they will not finance to the public services and all. After that, like there is a no competition between the domestic taxpayer and the MNE, or like there due to the BEPS, what will happen, like individual taxpayer will pay the higher tax and all. So this is the action plan number. Like before the action plan, there was a one concept, BEPS and adverse effect. This was the SM question, as well as in July 2021 exam they already asked this question. So question number 1. Now question number 2, what are the significant OECD recommendation under the action plan number 1 of the BEPS, that is digital economy, and which recommendation has been adopted in the Indian tax law? So guys, recommendation, first they mention about that, okay, you should significant economic digital presence, that company should be treated as a PE. Or suppose in your country there is a server is there, then that server should be treated as the PE. Or suppose there should be a final withholding tax or TDS, as well as the equalization levy. India opted the equalization levy. Till now India opted the equalization levy. That is the action plan number 2. Now question number 3, describe the 3 structured transfer pricing documentation. Just we did it. 3 structure documentation plan. One is the master file, local file, and country by country reporting. Local file, like whatever transaction arm length price and cup method, and that is called local file. Master file just give the overview of your group, and guys, country by country reporting we already discussed. So that is the question number 3. Now question number 4, what are the ways in which the hybrid mismatch arrangement are used to achieve the unintended double non-taxation or long-term deferral? So guys, there were certain example, and that example was related to the hybrid mismatch arrangement. Means you are creating 2 deduction for the single borrower, means loan is taken once and interest is claimed in 2 country. Or suppose you claim the interest deduction but not included in the income, or misuse the foreign tax credit or participation in the exemption regime. So this were 4 were the example. Now question number 5 says that this was the part of RTP also. This point says that, okay, what is the meaning of the and difference between the hybrid mismatch and branch mismatch? Briefly mention the reason why hybrid mismatch arrangement arise. Which action plan of the BEPS gives the recommendation in this regard? So this is related to the action plan number 2 of the BEPS, hybrid mismatch arrangement. So guys, hybrid mismatch arrangement means what happened? Okay, suppose if there is a one country treat any company as a opaque and one country treat any company as a transparent, then there is a mismatch. Or suppose one country treat any instrument as a debt and one country treat any instrument as a equity, then there will be a mismatch. So that is called your hybrid mismatch arrangement. As well as they specifically mention there is a branch mismatch. And guys, India has not followed anything. India has not made any change in the law to avoid the hybrid mismatch arrangement or the branch mismatch arrangement. So this is the question number 5. Now question number 6 says that what do you mean by the thin capitalization? Why it is considered as an anti-avoidance measure, and which action plan of the BEPS address the thin capitalization? Explain the provision incorporated in the Income Tax Act 1961. So guys, thin capitalization means whenever in any country their tax rate is high. So what MNE group will do? That associate enterprise, they will fund through the debt only. They will never fund through the equity. They will fund through the debt, more and more debt in the country where tax rate is higher, because interest is a deductible expenditure. They will reduce the profit, and they will reduce the profit means they will save the taxes. So that is called thin capitalization. Now why it is considered as anti-avoidance measure? Obviously because what happened, okay, if your interest is higher, your tax is lower. Now guys, action plan number 4 is related to the thin capitalization, and action plan number 4 says that there should be some ratio of the interest, means interest should be allowed only up to that extent. And guys, you know that India says that EBITDA 30% ratio. There is a section 94B, and in 94B we have mentioned that 30% of your earning before interest and tax or depreciation and amortization should be allowed as interest. So this is the question number 6 from your book. Now question number 7 says that what do you mean by digital economy? What are the taxation issue in the e-commerce, and list out the OECD recommendation under action plan number 1. This was the May 2022 exam question. Now guys, first action plan was related to digital economy. In digital economy, there is a difficulty in characterizing the payment, nature of payment, establishing the nexus or link between the taxable transaction activity and taxing jurisdiction, as well as there is difficulty in locating the transaction, where transaction is located, where activity has performed, identifying the taxpayer for the income tax purpose. And guys, following are the OECD recommendation. They are saying that modifying the PE definition, as well as virtual fixed place business in concept of permanent establishment. Suppose if one server is located, so just treat servers located company as a PE. Or guys, final withholding tax or the equalization levy. So that were the recommendation of action plan number 1. After that, question number 8. Explain the action plan for taxation of income arising from intellectual property right in India on the basis of OECD recommendation for the BEPS action plan number 5. So guys, action plan number 5 says that counter harmful tax practices. So India has introduced one section 115 BBF, and 115 BBF says that if any patent is developed in India and 75% expenditure on that development is incurred in India, then only you will get the benefit of 10% on the royalty. Otherwise you have to pay the normal tax rate on that particular royalty. So this is the action plan number 5. And significant economic presence of non-resident in India shall also the constitute business connection in India. Answer is yes. So in the non-resident taxation we have discussed that suppose if any non-resident is doing any activity with the resident person and that transaction is more than 2 crore, or suppose a user is more than at least 3 lakh or more, then it will be treated as a significant economic presence. You got my point or not? Yes. So these are the all 8 question, and if you do this 8 question, if any question comes from this topic, you can easily get the marks. In this time paper, November 2023 paper also, there was question from the BEPS. So here, November 2023 paper, I can show you that what was the question in the examination. So 6 mark question was there. 6 mark question, I think. Yeah, I'm just showing you the question. Yeah, this was the question. Last part, B part. Examine the correctness or otherwise of each of the following statement in context of the BEPS action plan and Income Tax Act 1961. Answer in brief with reason or context thereof. Now guys, country by country report not required multinational enterprise to provide an annual report of economic indicator. Explain the following with reference to the BEPS. Guys, there was a BEPS action plan number 13 related to the documentation, and there is a country by country reporting, and in country by country reporting they have to submit all the detail related to all the economic indicator. All the economic indicator means they should mention about your profit before tax, profit after tax, number of employee, number like total cost of the employment, everything they should provide in the country by country reporting. Now second are, what are the basic 3 fundamental pillar of the BEPS action plan? So guys, there was one is the coherence, second was the substance and all. So that should be the 3 indicator of the BEPS. And guys, why there is a need of international collaboration? Because like you know that people are arbitraging the domestic law. Every country is having the different law, so people are doing the people are using the arbitrage strategy and they are not paying the tax. So there is a need of international collaboration. So this was the 6 mark question this time in the examination. Very simple question. So whatever we did now, if you study this much, you will get the marks from this 3 topic. Now guys, last action plan, we will discuss little bit about that action plan after break. Now just take the break for the 10 minutes, and in that 10 minutes just go through all 8 questions again. Okay, so there are all questions we have completed related to the BEPS. So just take a break for 10 minutes.